Hey everyone, welcome back to Corporate Decoder, the place where we decode the financial secrets that companies try to keep hidden, but that actually tell us so much about their true story. Today we're diving into a report that might seem a bit dry on the surface, but has some interesting bits about how a company is managing its future. What if a company's future hinges on a special tax ruling and a few tweaks to its legal papers? Well, that is exactly the story unfolding with Woodbridge Liquidation Trust in their latest filing. We're going to break down what this means for them and what it tells us about their strategy. Before we jump in, if you love getting these straightforward looks at complex company documents, make sure you are subscribed, and if you want to hang out with other finance geeks and discuss these filings, join our Discord community. The link is in the description below. So, what exactly happened on the 17th of October 2025? It might sound like just another date, but for Woodbridge Liquidation Trust, it was a pretty important day. The big news is that they made a modification, or as they call it, an amendment, to their liquidation trust agreement. Think of this agreement as the rulebook for how the trust should operate, especially after its original purpose is winding down. Now, why mess with the rulebook? The filing tells us this amendment was made to, and I quote, effect technical amendments to the Trust Liquidation Trust Agreement. Technical amendments sound a bit boring, right? But these aren't just for show. They're tied directly to a request the trust made to the Internal Revenue Service, or the IRS. This request is for something called a private letter ruling. A private letter ruling is basically the IRS giving a company its official opinion on a specific tax situation before any transactions happen. In this case, Woodbridge Liquidation Trust wants to extend the life of the trust beyond the 15th of February 2027. Without this special okay from the IRS, extending the trust life could mess things up tax-wise, potentially costing the trust a lot of money. So this amendment is all about making sure that when they ask the IRS for permission to stick around longer, it doesn't negatively impact their status as a liquidating trust for tax purposes. It is like getting the referee's nod before making a strategic play. This particular change is specifically amendment number 6. That means there have been 5 previous amendments. This suggests that the trust has been navigating some complex situations or evolving needs over time, and this is just the latest step in that ongoing process. When companies file these amendments through a form like this, it is their way of telling the public and the regulators exactly what changes they're making. Now, there are a lot of details in these filings that are just standard procedure, like confirming if the company's name or address has changed recently. In this case, it looks like there haven't been any changes worth reporting in that regard, which keeps things simple. We also see a check mark here indicating that Woodbridge Liquidation Trust is considered an emerging growth company. This is a classification that allows newer or smaller companies to benefit from certain regulatory flexibilities. Particularly when it comes to financial reporting and accounting standards, it means they might not have to follow all the same complex rules as the really big, established players. And of course, all of this is being reported to the US Securities and Exchange Commission, or the SEC, which is the government agency that oversees the stock market and ensures companies are transparent with their investors. They're the ultimate watchdog. The date of the report itself is the 24th of October 2025, but the earliest event reported is the 17th of October 2025, which is when this amendment was put into motion. This timing is crucial. It shows they are filing promptly with the event. Alright, so let's look at the big picture for Woodbridge Liquidation Trust. This isn't a company focused on growing its business or making new products. It is a liquidation trust. That means its primary purpose is to wind down the affairs of a previous entity, sell off assets, pay off debts, and distribute whatever is left to its stakeholders. The fact that they are looking to extend its life beyond the initial plan suggests that the liquidation process is taking longer than anticipated, or perhaps there are specific assets or liabilities that require ongoing management. What is interesting here is the focus on tax status. For a liquidation trust, maintaining its tax. Efficient status is paramount. Any misstep can significantly erode the value being distributed. By seeking a private letter ruling and amending the trust agreement, technically, they are proactively managing a significant risk. It shows a commitment to a smooth and tax-advantageous wind down. Now, looking at this in broader terms, what does this tell us about Woodbridge Liquidation Trust? Well, firstly, it indicates a company that is being very careful and strategic about its final stages. They are not taking shortcuts, especially when it comes to the tax implications of their actions. The fact that they've had 5 previous amendments suggests that the liquidation process itself might be more intricate or prolonged than initially foreseen. This could be due to complex asset sales, ongoing legal disputes, or unforeseen market conditions affecting asset values. The main takeaway here is that Woodbridge Liquidation Trust is prioritizing the integrity of its liquidation process by addressing potential tax hurdles head. On this focus on regulatory compliance and tax efficiency is a strength for a trust winding down its operations. It ensures that as much value as possible is preserved for the beneficiaries of the trust. The risks, if any, would lie in the complexity of the ongoing liquidation itself and whether the extension truly solves the tax issues without creating new ones. But based on this filing, they are taking a very calculated approach. Alright, that is our breakdown of the Woodbridge Liquidation Trust's latest filing. What is your take on why liquidations can take so long and how important tax rules are in these processes? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives into corporate filings. Don't forget to check out the Discord in the description for more discussions. Thanks for watching. See you next time.